it's obviously a very tough situation for the companies. No one was really prepared for a move to prices in the mid-20s. But what I would say is that these companies have done a pretty significant restructuring of their overall cost base, and it is at least a navigable path for them right now to be able to cut back on CapEx, but still maintain the overall payout structure that they had put in place for shareholders, at least in terms of the dividend. Now, buybacks are clearly not an option anymore, but I do think that the dividend is sustainable for now.
Well, obviously, one of the concerns is that as they've maintained capital discipline here, inevitably there's going to be further restraint, and we've already seen the beginning of that, I think, in the industry. But can we be comforted that OPEX levels will be maintained, that we shouldn't be concerned about risks being taken in this industry?
Well, I think in terms of OPEX, there's already been a lot taken out of the overall structure, and so I'm a little more skeptical about being able to take another 10% off of OPEX. I do think that CapEx is potentially going to be able to move down by 20% this year. That's what we've seen from most of the companies so far. But the other thing to factor in is that balance sheets are actually in reasonably good shape, and those can be used to finance any deficit spending that we see over this year and next year.
Jason, good morning to you from Downing Street. Look, I share a lot of your optimism about the skill set in these companies. I think the leadership in these IOCs is quite exceptional, but I have to say I don't share with you your optimism that the dividend can be maintained if we stay sub $30 a barrel. I just don't understand how, again, even with the quality at the top of someone like Royal Dutch Shell, they can maintain a 13% dividend yield or thereabouts, depending on the oscillation on a daily basis, when their oil cost per barrel is, even if they cut aggressively, is still going to be in the mid to high 40s. I just don't understand how you think that is sustainable, especially when also they've got the not inconsiderable matter of having the energy transition to pay for as well.
The transition is a fair point, and that is something that would be consuming, let's say for Shell, $1 to $2 billion off of a $20 billion CapEx budget. So that is still an important outflow that will continue. I think when I reference the ability to maintain the dividend at 30, it really does rely on putting more leverage onto the balance sheet. It's not something that they can do purely through the cash flows that they will be generating at that oil price. But bear in mind that there is plenty of capacity, there's plenty of liquidity at these companies. It's the number one financial priority for them. Now, with that all being said, I do think it's possible that you will see the reinstitution of scrip dividend programs, in other words, paying out the dividend in stock rather than in cash, to help maintain that liquidity position.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.